Let's take a look at some charts, information, and graphs on Bitcoin for Brave New Coin. Bitcoin began in 2010. Parts of it began pre-2010. Hashcash, Adam back. Standing on the shoulders of giants, evolution, dollar failure, gold standard, all these buzzwords you'll hear. And somehow we're here today in a time when Bitcoin should be shining, where the dollar purchasing power seemingly evaporating, inflation quite high historically on the US dollar. And yet we've been floundering over the past few months in a range. Has the halving mattered? Do macroeconomics matter? Is it all just supply and demand? Those are the questions a lot of people are going to be asking if we go into a broad bear market in 2022. Bitcoin is still proof of work. It likely will never switch to proof of stake, nor should it. We'll start with the hash rate and difficulty, which from January 2019 until April 2021 made nothing but all-time highs, essentially month over month. China says no more mining in April. China, the government, they also say no more trading in crypto. Now that certainly had an effect over the past month as they're closing all exchanges for trading by the end of the month, by the end of the year. And you can see the hash rate fall off quite a bit here, difficulty as well. All of that has since been regained. It's either gone elsewhere or picked up elsewhere in various countries for various reasons, including cost of electricity. Texas in the US is a big one. And we're essentially sitting back at all-time highs for hash rate as well as difficulty. If we look at the ASICs available at 4 cents per kilowatt hour, which is what most miners get or better, all of the ASICs basically in existence except 2014, 2015 ASICs, which there probably are very few working available. I mean, you'd see these in museums at this point, or will eventually. Everything else is profitable, varying degrees of profitability. The key here, if we are entering a bear market, not an expectation, but it's important to analyze every branch of the decision tree, every node, every leaf, every budding possibility. The important part here with mining is to figure out where are miners not in profit anymore. That might be 14K. It might be 16. I haven't seen the number mathed out in a while. It's going to vary from place to place based on electricity, overhead, loan collateral, deals done for electricity. It's going to, all that stuff's going to influence like the ultimate value on a miner to miner basis. But if you're a miner at scale and you have to pay for electricity and you can't, or your futures contract is expiring and you can't afford to go on, right? I mean, there are many reasons and ways that miners can really get crunched in a bear market. So those are certainly signs to look for. And we can see that on chain as well as in the news when things are happening. But at least on chain, you'll know exactly what's going on. And we can see difficulty changing. This was the Chinese exodus here. This explanation, I'll never know. I don't think at least this year, we didn't know why this rebounded so hard. This, I believe, was Chinese flood stuff that they said happened, and which may have been insiders in the know, getting rid of their mining equipment or something, right? I don't know if we'll ever know what's actually going on the ground in China. Then we had this extremely large increase, and then it was just nothing but decreases. But since then, hash rate or difficulty has continued to increase. Most recent adjustment +8, the largest in a while. So miners are still adding to hash rate. I like to look at Puel multiples from looking at bitcoin.com. Great website, tons of info here. This is the how rich are the miners metric, daily coin issuance versus the past year in notional terms. And in general, this lines up with highs and lows. You can see this year, we certainly didn't hit a high, barely creeped into that low. And where we're sitting now is kind of at parity or unity, however you want to think about that, around 1. So not in the buy zone, not in the sell zone. Doesn't really help you much on balance as far as decision-making process. But this is something to watch for if we do go mega bear in 2021, 2022. Even if we go mega bull, I'd still watch this into 2022. What's really concerning to me is the amount of supply that hasn't been distributed slowly over the past few months. This is miner outflows. We can look at when Bitcoins were birthed, when they were mined, when they were created into existence, and when they were moved. Assuming the data is correct from crypto quant, then for the most part, there really hasn't been a big spike in outflows. You could say, well, this is good, this is bullish. Miners aren't selling. They're doing something else. They're hodling, they're getting loans, they're trading futures, whatever they're doing, collateral. Again, this is going to vary on a miner by miner basis. But the reason this is so important is because they hold so much BTC. And what we don't want to see is outflows from miners as prices going down. We saw that in 2018, November, and we certainly know what that looks like. Now, that happened for a variety of reasons, including Bitcoin ABC, hard fork, and all sorts of other shenanigans. But this is what you want to see. You want to see miners letting go into strength. Most miners, not the best traders, but this is what you want to see. You want to see them selling into strength. If miners are selling into weakness, and shorts are piling on, and people are getting liquidated on leverage, that is 2018 all over again. Not to be a doomer, but it's certainly not a bullish scenario. And if we look at miner unspent supply, it is extremely high relative to the entire year. This has only been rising the entire year. This is just another way to show the crypto quant data. Miners are not selling. I wish they had 2018 on here because then you'd see a big spike, most likely, if my memory is correct and data is correct from that time. So we really don't want to see spikes in a downtrend. So that's definitely the mining story to watch for in 2022 is miner outflows, 100%. They're sitting on a notional metric ton of BTC and USD right now. Looking at transaction counts on the network, these have essentially continued to decline since 2019. The recovery here was due to Veriblock. Some of this is in the Lightning Network now, so it's going to be incredibly hard to really understand what's going on here in transaction count land for BTC, for ETH, as things go layer 2, as things become more than just A to B. Let's look at that. We're going to onboard into Lightning and then do a bunch of stuff and then come back into BTC. How do we incorporate that into on-chain metrics? I don't know if we have an answer for that yet. But on-chain, transactions have been declining since 2019. Certainly declining over the past month, which on its face isn't bullish by any means, but it is not declining to the degree it did in 2017, 2018, even late 2018. Where's that? It's August, September, October. So this was November, December. It's a blip on transaction counts, right? But on price, it was a massive, massive deal. If we add transaction values to this, you're seeing a rise generally in average transaction values. Yes, prices at all-time highs, I get that. But this is also representative of just fewer microtransactions on-chain in general. You'd have to look at that deeper to see some absolute value metrics. But for the most part, as you see a decline in microtransactions, you're going to see a rise in higher transaction values. And another story for 2021 has been ETH versus Bitcoin fees. ETH fees are a runaway freight train, or at least they have been for several months. And to some degree, that's certainly bullish. It says they are having growing pains. They need to scale. The question is, will they do it soon enough? Can they do it soon enough? BTC mean transaction fees sub $2 down here, ETH 27. The other thing this does not show you is the complexity of ETH transactions versus BTC transactions. You can certainly do a lot more stuff on ETH relative to BTC, but that's a difference of use case. The point is that ETH transaction fees are incredibly high to do anything world computing like hundreds of dollars per transaction just to add liquidity to something, for example, for me on Enzyme regularly. So it certainly hasn't helped DeFi, hasn't helped ETH relative to other layer 2s. But most of us likely remember 2018 and what that was like, 2017 for fees. Certainly remember April 2021. The mania and fervor we saw in both of those times certainly is gone here. I mean, you can look at fees, you can look at pending transactions. All of that is just silent, essentially, from where it was in 2017 and earlier this year. So is it painful to see high fees? Yeah, sure, but it also tells you there's a lot of people in the game on chain. Active addresses for BTC certainly down from the 1.1 million plus all-time highs in a big way since May. Some of this is mining related or was mining related, both up and down. Recently, active addresses on a monthly basis curling down as well. Also not bullish on its face. So transaction counts, active addresses, not bullish, just as we sit here in the moment. Now that could change next week. But what you don't want to see if you're bullish is a rapid decline in on-chain activity for anything, ETH, BTC, whatever. You don't usually see bullishness in price with a decline in on-chain activity. We can continue to look at different types of on-chain activity metrics. NVT is one of them, a measure of on-chain activity relative to market cap. And this chart is extremely visually busy, but it is telling you, based on on-chain activity in regards to market cap, NVT is currently at a low. So this is an inverse metric of economic utility relative to market cap. Historically, highs in NVT, or degrees of standard deviation, 4+, have been a pretty good signal for all-time highs in price. That is overbought up here, oversold down here. The issue with this is we can stay oversold for quite some time or under these lows, as we did in May this year. It was a full month down here, right? So yes, this does look oversold based on the relative difference of on-chain activity versus market cap, but it can stay here for quite some time, is the caveat. Something I much more prefer to look at is MVRV, market cap, in regards to realized cap, which is again another way to look at on-chain activity. And if we use a Z-score here, buy zone, sell zone, we almost got to that sell zone at the top. Not quite historically where we have gotten in the 7+ area. Currently 1.6, plenty of downside here, plenty of upside. You could say it's 50-50 coin flip. You can say we're trending down hard, we're closer to the buy zone. It's just something to watch for continuously, right? If 2022 is bearish, this is certainly the first thing I'm watching. How does this look? Let's say we're bearish and then sideways, like we were in 2015, like we were in 2018. What does price look like? In regards to realized cap, you can see it doesn't usually get far below realized cap. Realized cap currently 462 billion. That's market cap, not price, obviously. But this is another metric to look at, one that I certainly like over NVT. We can look at exchange reserves as well. These have continued to dwindle since July. Certainly we've been more bullish than bearish since July. But what you don't want to see is, along with minor outflows, a big spike in exchange reserves. Part of this dwindling has been China. Baked in here is Huobi, OKEX, Binance to some degree. China is likely leaving for good this time and never, I'm not going to say never, but never coming back based on the PBOC rulings they've had over there. So in a vacuum, I think it is safe to be bullish on this, but clearly, look at this decline here in price and exchange reserves. Typically what you see is a rise in exchange reserves and a fall in price, as we did kind of in May. That's what you'd expect, right? If you're sending coins to an exchange, it's probably to sell them. So it's probably a bearish event. So this is some type of divergence, right? I guess you could call it a bullish divergence, but it is a bit odd still. Lightning Network, another big story this year. Venezuela getting on board in a big way, viewed by some as good for the people of Venezuela, viewed by some as bad for the people of Venezuela, the way it was enacted. But we can sort of see the effects of what's happened over there in the Lightning Network to some degree. It certainly isn't one-to-one correlation, isn't causation, but network capacity has certainly increased over the past 6 months. You can't deny that. Does this represent some degree of coin lockup? Yes, but it's not like it's vested. It's not like it's a hard lock or anything like that. It's not ETH 2.0 where they're being squirreled away until ETH 2.0 gets released. So you certainly don't want to see declines in this if you're bullish, declines in capacity there. Look at the hodl waves. This is another one, like my top 5 things to look at for Bitcoin in a bull market. In a bear market, not so much, but if you look at all the coins that have moved in the past 6 months, the highs in price have for the most part correlated with a 50 to 60% move in on-chain activity as a whole. In May, we hit just over 40%. I'm looking at this scale over there on the left, and we've been dwindling ever since. And there are all sorts of other metrics you can look at on top of this. Glassnodes does a lot of this work. You can look at realized profit or losses for the newer users or the newly moved coins. You can see that there were X percentage of losses realized based on recent onboarding because they're being moved, right? You can say stuff like that. But ultimately, as a metric, I'm just paying attention to highs in price relative to 50 to 60% of the chain moving in the past 6 months. Certainly not there yet, but if we are bullish into 2022 or bullish at all in 2022, this is something else to watch. Bitcoin Google Trends past 5 years. essentially flat since July and kind of mirroring prices as worldwide. We did have some pops here in January to May, didn't eclipse 2017, and we're certainly not sitting at lows here. So it's about as bullish to neutral as you'd expect, I think. You know, we aren't in the depths of a bear market where nobody cares about BTC. It's certainly being talked about fairly often. Because it's the end of the year, we can also look at what was trending in the US anyway. And I thought this was super interesting. In the news trending stuff, meme stonks, stimulus check, gambling, a lot of that type of stuff. And one of the top how to pronounce things was Doge, or the top pronounced thing. Thought that was funny. And if we scroll all the way down, if it's still on here, one of the top what is searches in Spanish was what is Bitcoin, probably because of, I keep saying Venezuela, it's El Salvador. I don't know why I mix those two up. Probably because of El Salvador and the Latin America effect that's had. Certainly in the news in a big way. Flipping gears to technicals, also going to stick with log into Bitcoin for now, but logarithmic growth curves. If you want like maximum hopium here, hopium, copium, I don't know. I think it's fine either way. There's a few ways to interpret this. The first being is, where's the midline? Are we above or below that midline? That gives you a sense of bullishness or bearishness. Second thing to look at is obviously how far away are we from the low versus the high of this channel. And you can say it's curve fit because it is, and that's the point, right? If it makes sense on backtesting, then you use it for forward testing and or the future and go from there. So look at the midline, look at the extremes. Where are we relative to either of those things? We're certainly not oversold. We're not overbought. We are below the midline. The downside is somewhere at 25-ish. It looks like 25 to 28. Historically, we've only dipped below this during Corona March and then quickly recovered after that. The past doesn't predict the future to some degree, but it does help you understand where you are in overbought, oversold. So that looks fine. 28 is the low there. The high is 150. One glass half full way to look at all of this is that we didn't hit 100K this year, so that we have the potential, or coiling, to hit 150 plus next year, right? If you want to be on the bullish side of the argument, I don't think that's invalid. I think that's fair, but I'll believe it when I see it, when we start making highs. One of my favorites, 2-year MA multiplier. Also, you can be used as an oscillator. The high here at 143, the low at 28, buy zone below 28, sell zone above 143. Another way to read that. Very clean cut, very straightforward. This has never been wrong for the most part, depending on how you want to look at this. You could argue it was wrong that the top was slightly lower here, but it just kind of eked out on the February 21st. You know, that wasn't the all-time high, but it did give you a pretty good sign that things were up there quite a bit. So going into 2022, I'd look for 28 and 143, obviously massive range, but when we're neutral without a broad bias, you can't really say one way or the other. 200-week heat map is at 18. So for me, the range is 18 to 28. That's your buy zone, that's your bear market low. This thing has never held below the 200-week moving average. The heat map tells you how fast we are moving on the 200-week, and we've slowed to a crawl as far as moving up or down. We're in the blue slow zone, the turtle zone, not the rabbit zone. So we've essentially reset any high momentum we've had or did have going into February to May. Pi cycle top. This was probably the thing I was the most wrong about this year. Back in March, I said this thing is about to cross, ignore it. And it was the only thing that told you effectively that it was the high. There were other ways to analyze Pi cycle top that show a more exacting value, but ultimately this has been good enough. It's been good enough the past 4 times now. It's told you within 5 to 10 days that that is the top, right? Again, this is not the exact top at 59.8, but considering where we're sitting now, I think most people would be happy selling at 60 relative to where we are now in the near term. So this is certainly something else to watch for if we go mega bull in 2022. Doesn't really help you in a bear market. That's where the 200-week moving average comes in. Here's a pitchfork, yearly pivots, 200 EMA, VPVR, zoomed kind of way out. Just another way of looking at everything I've already looked at, telling you what is the rate of change since 2019. Pick 3 points and off you go. Does it make sense? Does it fit within these lines? And we've held above the 200 for the most part since April, currently kind of near it. Sorry, this is the 400 daily, 200 2-day. Anyway, we're still neutral. We're on the bearish side of neutral. We're on the underside of the midline here. You'd much rather prefer to be up here if you're bullish. Downside somewhere between 20 and 26 as far as holding this range of change, maintaining it, and the upside is certainly well above 110. But until we're distinctly above or below, it's hard to really say directionality to a strong degree. So for me, that's a neutral read on that. We are below the clouds, so that is a bearish read on that. And how this may turn out, however, is a move to 55. 55555 is certainly in the cards here because this is a multi-week, I think, falling wedge now. A series of lower highs, series of lower lows. There's a bull div on this. I don't have that on the chart. But you could trade this as a bullish reversal expectation. Measured out, the 1618 is around 55555. This would retrace kind of all the China nonsense as far as the exchange selling goes. If you're wrong, it's going to 40, which is why you need a tight stop at probably 45. But the risk reward there is on your side for a long. I just think looking at on-chain data and looking at trend metrics, being long here is not the smartest thing to do because ultimately you want this thing back above the cloud with a higher high expectation. This also is printing, along with that 4-hour falling wedge, it's printing a TKC clamp in the bullish direction. Last month, I talked about a 54 because that's where the Kijun was at that time. That's where the mean was at that time. And we were at 63.5, and I was talking about 54. So we're at 46.8 right now, and I'm talking about 55, 56, because that's where the mean is. It would make the chart look even sloppier than it already does, but it's certainly shaping up to look like this falling wedge is real in the near term. So I don't hate that setup at all. And then looking at alligator fractal, lastly, as far as trend metrics are concerned, again, we're not bullish here. We haven't been bullish since these MAs crossed bearish in late-ish November. So as long as we're below this and this is crossed bearish, the expectation is lower lows. The expectation is anytime we breach a fractal, we're going lower. So those are your short entries. Your stop loss on any short here is around 50K. And you can backtest this. Historically, this has lined up quite well. So a bit of a mixed bag going into 2022. In the longer term, I do expect Q1 to be mainly bearish, Q2 to be bullish, Q3 bear, Q4 bull. This Q4, we've basically kind of retraced the whole thing. We're up slightly from October 1st, but we did have some unusual stuff go on. Not to make excuses for seasonality, but to see a whole country's exodus for the second time in a year certainly didn't help crypto broadly, but specifically BTC. So like, dislike, comment, share, subscribe, and happy trading.